that specify a currency to be exchanged, the exchange rate, and the date at which transaction will occur. So Florian, your question, you were asking back in those lecture, what if we want to fix the exchange rate, right? We talked about floating exchange rate system that, exchange rates are moving day by day, even minute by minute, right? So if you are planning something, right? So the biggest risk is currency risk. Why? Because maybe when you want to buy, you plan something, and when you actually want to buy, even the payment is going to be transferred, currency appreciate, and then you lose a lot of money. So in that case, it is, the financial managers, especially the currency managers, are to be blamed. So in that case, you basically go to some contracts. Okay, I am going to buy this currency at specific exchange rate after 3 months, 4 months, 1 month, 90 days, 30 days, 270 days, 1 year, right? And this much currency amount also be given. Okay, for I want to be buying 1,020,000. This is going to be 1, 2, 3, 4, 5, 6. So $10,020. I would be buying from you $10,020 at 7 yuan per dollar on 30th of December, right? So this 7 yuan is exchange rate that is in contract. So that rate that mentioned in contract, we call that forward rate. So if you still don't understand, so let's make an example here. So a forward rate, a forward contract is a contract between two parties. So this is party A, party B, which is dealer. Party A can be individual, can be company, can be government as well, right? Any party who is dealing with the dealers, and dealer can be banks, can be exchange rates, exchange systems, OTs, over the counter, markets. So you made a contract. You said I would be buying $10,020 from you, for example, after 30 days, no, 90 days. So right now you are at 0. So at the 0, this contract is initiated, and this is the contract value. Oh, 10 million, right? And the rate is going to be 7 yuan per dollar, right? So maybe when the contract ends, when you are here, the rate is now 8 yuan per dollar, right? 8 yuan per dollar. So this is the market rate. Market rate, which market rate? Spot market rate. When? After. So we don't know about this unless we are on 30th of December. We saw in the market rate is 8 yuan. So if you have not done this kind of arrangement, right, you would be paying more or whatsoever, yeah, more yuan to dollars, right? In that case, you will be at disadvantage. But since you have a contract, so whatsoever, you will buy dollar at 7 yuan. because you have a contract. And remember, contract is obligation. It's not an option. If you have this contract, you need to fulfill that one. So again, forward contract is an agreement, right, between foreign exchange dealers and companies that specify currencies. Okay, what you need, yuan, dollar, or yen, euros, pounds, what you need. So you specify the currency to be exchanged, the exchange rate, and the date at which the transaction will occur. So the rate on which, the rate that is mentioned in the contract, we call this forward rate. So forward rate is an exchange rate specified by the forward contract. So the contract is called forward contract. The rate at which we are going to exchange after some time or in future, we call this forward rate. And from where we go to have contract, this forward contract, that market is called forward market. And remember, this is over the counter market, which means this is customized market, because I said I would be needing 10 million and $20, right? You can also have $100 as well. You can also have 150, 20, 150 and 150,000 and $203 as well, because this is customized, right? So again, forward contract is an agreement. An agreement is bound by law, right? So if you enter the agreement, then in that agreement you will be mentioning the currency you are, trading with each other to be exchanged. On that, the rate would be mentioned, and that rate is called forward rate. The amount will be mentioned as that, and time also will be mentioned, right? And the market in which you do forward contract, we call this forward market. And remember, this is a part of derivatives. And nobody asks what is the definition of derivatives. In some accent, we call this derivative. I think in UK accent, we call it derivative. Okay, so don't go with this, pronunciation. Just remember what suits you. Remember that derivative or derivative is the same thing. So derivative is, or derivative is, whose value is, depends on some other factors, or whose value is going to be derived some other events. So you see, this value is, the forward contract value is not based on market value, it's based on contract value. That's it. So that's why we call this derivative. We also have derivative in stock market as well, but we are specifically reading currency derivatives. Yes, Florian.
I have a question. So if I understood well, I will say, for example, I will buy this product at this price this day in the future, right?
Yeah.
It's like a contract call, like a future option, like in the
No,
future.
no, there is a
That's not
difference between option and obligation. So this is contract. Contract is obligation. You must follow that one. That would be the options we will talk about in coming slides. That would be options,
okay.
right?
So it's not an offer call. Okay, understood.
This is contract, and contract is bound by law, right? Okay, let me explain this as well. I think you raised a very nice question here, so let me just. So this is a contract between two parties, party A and party B, right? A contract. So, and you said that after 90 days, I would be buying $150,000 from party B, right? For example, at 7 yuan per dollar. But what happened after 90 days? The price is, come on. For example, the price is 5 yuan per dollar. So it is cheaper for party A to go to the market and buy dollars at 5 yuan. But since this is contract, the party B will say that no, 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 you have to buy $150,000 from me at 7. Or what if in the market after 90 days it's 15 yuan per dollar? And if party A said, look, I want to buy this at 7 yuan per dollar, you cannot refuse. Then it is obligation of the party B to send $150,000 at, so no matter what is at that time in the market, both party will be obliged to honor this forward contract, right? This is obligation. You cannot reverse this one. You can reverse, but you cannot back off. Understand? So question is how you deal with that one. So that you agree between party, this is the agreement between party B and C. Party B will say, okay, you need 90 days forward. Okay, 90-day forward going to be $7. And you said, no, I'm not asking you $500. I'm asking $150,000. Then he can say, okay, 6.9. So that is just a negotiation between party A and party B. But since now we are having in digital world, digitalized economy, everything is digital. So the big houses, the currency houses, foreign exchange houses, they publish their forward rates, on minute by minute basis. They have the forum. You can log on over there. You can see that what's going on, what's the forward of, dollar into yen, dollar into pound, dollar into, your local currency. So they already gave you this kind of stuff, and you fix in advance whenever you enter the contract, you cannot back off. So it means in this condition, one party lose, one party gain, right? So but even if you contract at 7 and now it is 5, even then it is beneficial for party A. Why? Because party A is a company, and company needs financial planning, funds planning to pay for its plant and machinery or whatsoever, right? So for 3 months it need to gather resources or gather fundings, so that the managers will say that our job is to run the company,